to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, this week's market wrap with commentary and analysis from Money Metals Exchange, the company named Best Overall Precious Metals Dealer by Investopedia.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Coming up, don't miss another incredible interview with Greg Weldon of Weldon Financial. Greg weighs in on the post-election price action in the metals markets, discusses what the Trump effect may be going forward for gold, gives us his latest insights on silver, and also shares some fascinating thoughts on Bitcoin. So be sure to stick around for an interview you will not want to miss with one of our very favorite guests, Greg Weldon, coming up after this week's market update. As anticipation of a crypto-friendly Trump administration lights a fire under Bitcoin, the gold market is bouncing back strongly. Bitcoin surged to a record high of 99,000 this week. President-elect Donald Trump has vowed to make the United States, quote, the crypto capital of the world. He is also reportedly working on plans to create a national strategic stockpile of Bitcoin. In the meantime, Bitcoin enthusiasts are celebrating the announced departure of Securities and Exchange Commission Chairman Gary Gensler. Under Gensler, the SEC has moved to tighten regulations around cryptocurrency markets. President Trump will have the opportunity to appoint a new SEC chair who will presumably be more friendly towards cryptos. That said, the crypto space has been beset by numerous scams and is fraught with risks. Anyone considering buying Bitcoin in the midst of this euphoric melt-up should be aware that downside risk is significant in this notoriously volatile asset class. Whatever its virtues as an alternative store of value, Bitcoin isn't gold. No digital asset can substitute for hard money in tangible form whose ability to retain value has stood the test of time. Gold did come under several days of heavy selling following the election results, but it is back on the upswing this week. The monetary metal has rebounded by over $130 or a robust 5.2% since last Friday's close to bring spot prices to $2,711 per ounce. Turning to the white metals, the silver market shows a weekly gain of nearly $1 or 3% to come in at $31.35 an ounce. Platinum is advancing 2.6% to trade at $978. And finally, palladium is popping 5.8% higher this week to command $1,045 per ounce. Well, as the Thanksgiving and Christmas holidays approach, the window of opportunity to make moves in your personal finances before the year end will narrow. It's especially important to consider any tax advantages you may want to implement before the calendar turns to 2025. For example, deferring capital gains while realizing any capital losses on investments may help to reduce your tax burden in 2024. You might also consider making charitable contributions or shifting forward any deductible medical, real estate, or business expenses rather than waiting to incur them in the new year. Now is also a good time to consider making contributions to tax-advantaged accounts such as IRAs. For 2024, individuals may contribute up to $7,000 to an IRA. For those over age 50, that amount increases to $8,000. It's also worth considering adding physical precious metals to your IRA. In order to do that, you'll need to set up a self-directed IRA with an IRS-approved custodian. Money Metals is happy to work with customers who are interested in funding an IRA with bullion. Some investors understandably don't want to deal with the compliance hassles of IRAs. The IRS imposes rules on how and when you can contribute, what you can invest in, when you can take distributions without penalty, and when you must take distributions. Bizarrely, the IRS considers it acceptable to take IRA distributions after you turn 59 and a half, an age that no normal person keeps track of on a 365-day calendar. Over the decades, Congress has offered Americans various savings vehicles for retirement, education, and healthcare, and all sorts of credits and deductions for all sorts of things. But they all carry arbitrary and complex rules that drive up compliance costs and drive many taxpayers to frustration and exasperation. Elon Musk's Department of Government Efficiency notes that there are more than 16 million words in the tax code. Navigating the tax code costs Americans 6.5 billion hours each year. The Department of Government Efficiency will propose some much-needed simplification. One of the onerous tax provisions that unfairly hits precious metals investors in particular is the so-called collectibles tax. The IRS considers all bullion products to be collectibles and taxes them at an elevated long-term capital gain rate of up to 28%. But a pure gold bar isn't like a rare stamp or autographed baseball card, whose value is based almost entirely on intangible factors beyond material and manufacturing costs. The value of a gold bullion product is based almost entirely on the price of gold itself. That distinction could be made moot if Congress would simply get rid of the collectibles tax and stop punishing investors who hold physical assets instead of Wall Street assets. Alternatively, the IRS under the incoming Trump administration could issue new guidance that states ordinary precious metals bullion products are not collectibles. This would require no new law from Congress, just a more sensible interpretation of an existing law. Well, now, without further delay, let's get right to our exclusive interview.
Greetings, I'm Mike Meharry, a reporter and analyst here at Money Metals, and I'm joined here today by Greg Weldon. Very excited to have him back on the show. He's a market researcher with decades of experience, everything from working as a gold and silver floor trader at the COMEX to institutional broker to portfolio manager, and now as an independent market researcher who is in very high demand. How you doing today, Greg?
I'm doing great. How about yourself, Mike?
I'm doing well. I'm glad to have you on the show. I appreciate it. You're kind of coming on last minute for us, and I appreciate that very much. So I thought we'd kind of start off, talk a little bit about the election and Trump's victory. And I don't know about you, I wasn't really shocked by the result, but I was a little bit surprised that he won as handily as he did. Kind of what were your thoughts on the election itself?
Well, my thoughts were he's either going to win in a landslide or they're going to steal it. So, I mean, or the other side would steal it and make sure that he can't be president. And there's a lot of people that think that something's going to happen between now and January that's going to still make that, the case. So, we're not quite to the finish line yet from that perspective. Now, I don't necessarily think that's what's going to happen. I think there's a couple of points that need to be made. The first one is that the stock market rallies right away, that this is a new era. It's a new, sense of this pride in America. Waiting for Charlie Daniels and the fiddle to come on. We're never, never going to beat America. We stand together again kind of thing. Yeah. And I love it. Okay. And I'd love to think that that can happen. The problem, Mike, is that this is not 1982 Ronald Reagan, okay? Yeah. This is not coming off the Paul Volcker where he defeated inflation with high interest rates and you had no debt. You have so much debt now, it changes everything. And when you listen to Jerome Powell speak, kind of going back to 2018 with the white papers, 311 pages that the Fed put out, and the Jackson Hole speech, that was kind of a landmark speech, if you will, laying out the new policy paradigm. And this would be, we're going to let inflation run. There's no tolerance bands, meaning we're not going to say if it gets to 5, we'll start to adjust policy. We're going to let it run free and wild to whoever wants to get, and then we'll rein it back in. And we know how to do this. Paul Volcker gave us the playbook for this, and that's all well and good. The problem is that both Yellen and Powell had mentioned things like we need to see consumer credit come down. And the last thing you want is a credit crunch. I mean, that's the absolute worst scenario than an inflation, because, in fact, they can fight inflation. They can't fight a credit crunch, not with policy. We already learned from the failed European experience that negative interest rates don't work. It sends the wrong message. So from the perspective of then taking this back to this is almost a Reagan-like revolution, that's just not the way it's going to play out because of the debt issue, number one. And, Trump will expand the debt. I don't like the way that the media made it out that he was more of a debtor than was Biden. Biden was by far the biggest debtor. It's not even close. And if you extract the second quarter of 2020, when Trump saved the economy with $3.5 trillion, it's 2-1 Biden. It's not even close. So that whole narrative on the bond market is faulty from the start. But going forward, maybe it's not so faulty because, of course, the only thing we can do is print our way out of it. We've chosen this path, and we're going to have to stick to it. So this takes us back to where are we now with this seemingly big breakout? Is there going to be a 20, 30% rally that goes on for a year and a half in stocks here because of this? No way. All right. The economy, people say the economy is strong. And I saw the guy today, even you get the bankers who come on. You have Bank of America, you have Capital One. And the guy today was from Wells Fargo on television talking about how strong the consumer is, how much spending the consumer is doing. And it's like, of course, you're talking this because you are the credit card lenders. All right. So, and this is what they take their data from is their credit card receipts. And we know that people are, stressed out and using their credit cards to pay the bills. We know that consumer savings is now less than credit card debt. Personal savings is below credit card debt. The only other time we saw that was 2007. Delinquencies now are above 10% on the seriously delinquent credit card. The only time we saw that, 2008, 2007, 2008. The similarities in the consumer are really mind-blowing. And when you look at the retail index against the stock market, it's breaking down. It's near the 2020 lows, and it has not kept pace, and it always leads one way or the other, and it's basically warning that a major correction is coming because you're disconnected from the economy. The economy is not AI, and I think we said this even on your show before, that AI is great, and AI will revolutionize things, but it's not the internet, which was price discovery. That was different. This is actually replacing human tasks, and doing it more efficiently, and that's what businesses need now to keep pace because of inflation. So It all kind of fits in. But when you kind of then start to talk about the consumer, and when this AI thing, and it kind of starts to be running out of steam a little bit, the tech sector's been the leader, the XLK and the semiconductors. They're failing now relative to the S&P. What's the engine of economic growth here, and what is going to lead the stock market to the next bull market leg here? I don't see it. I think you're going to have a day of reckoning, if you will, to kind of correct these really wide divergences, and then that's what's going to force the Fed to acquiesce, because inflation is already rising. You have problems with food. You have weather. You have drought. You have the U.S. right now is more than half of the country is in a moderate drought, and 25% of the country is in a severe drought, and it's one of the worst droughts outside the one we had 3 years ago in the last 100 years. So food prices will be interesting over the next 12 months too. So to make a long answer shorter, all right, the bottom line is you are in this situation where the feel-good factor's kicked in. There's going to be a check. There's going to be a reality check to that. And when that happens, and so just to add the one little layer that's important that I missed here, which is the real Trump trade is a higher dollar, all right, because of the interest rate differential, number one. And more than that, because of tariffs would be a dollar positive thing for some time at least. Right. So the worst thing for the stock market is the dollar appreciation. It's directly negatively correlated, and it's the most tight and historically significant correlation that's out there between two markets. So a higher dollar on the Trump trade is not bullish for stocks. You don't have the Reagan ability to print money vis-a-vis debt to outspend the Russians, let alone the Russians and the Chinese and OPEC are banded. So Russia's a lot stronger now than it was in the early 80s. So all of this kind of works against that until it becomes evident above the ground that the consumer is choking and struggling. When you start to get some bad economic numbers, it will force the Fed to act. They're going to have to act aggressively. They should be neutral now, and that's not priced till the end of next year. None of this is fast enough, and I think that that's going to set up for the next big trade in gold, because the Fed's going to be behind the curve again and going to have to act more aggressively, and the dollar will come down finally. But in the meantime, there's probably more economic pain. There's probably more two-way action in the metals, and we'll see. I think you've had a correction that may be over already, but that's it's not a really overwhelming high probability either.
Yeah, it's amazing how much on the same page we are. It's one of the things I kind of watch is the consumer credit. The Fed releases consumer credit data every month, and if you've watched it over the last 2 or 3 months, it started to tank, especially the revolving credit, which represents primarily credit cards. Yeah. So you're starting to see that pain. And I wrote an article right after the election, and maybe it was too soon because it upset a lot of people, basically saying love or hate Trump, there's a lot of things that are beyond his control when it comes to the trajectory of the economy, one of which I agree with you is the inflation and the debt. And even if there is a will to rein it in, you've still got to get the cooperation of Congress, and I'm not sure that the will is there at all. And then on top of that, there's only so much discretionary spending that can be touched. Yeah. So I agree with you. Let's talk a little bit about gold and silver specifically. You mentioned that there was a bit of a correction post-election, and I wasn't really surprised by that. I doubt that you were either. I mean, you had some of that safe haven trade unwound.
Dollar higher.
Yeah, and the dollar higher, exactly. Just like you said. So it was looking like gold was running toward 3,000 before the little election correction. Do you still see 3,000 on the table as we move into the Trump era, or is maybe that going to be pushed back a little bit as we have this dollar strength?
Well, I got two things I would say. The first thing to answer that direct question is we predicted or projected, I don't like the word projected at the beginning of the year that 2650. And at that time, it seemed kind of outrageous and kind of people were that's kind of nutty, So, and we kind of adjusted that at some point to 3,000, but that was just kind of an alley-oop slam dunk. Yeah. I think that it's important that we go back to what you just said about the consumer, because we're getting the data. Like you just said, it's so important to look at sometimes the micro in the macro, right? Or the macro in the micro, I should say. And what you just said was perfect, because you have seen the Fed's consumer credit data, the revolving credits had 2 out of the last 3 months where it was actually, down. The rate of change was slowing dramatically. And then what we get to is the weekly commercial bank data last week. There was a 19.3 billion decline in loans, bank loans total. All right. We're talking about a credit crunch. All right. That's the biggest thing we have to watch out for here, because that'll make the Fed act really aggressively, which ultimately will be the thing that drives gold to the next big bull move. So that's why it's important to note this. And then within the 19.3 billion weekly 1 week decline in lending, bank loans, commercial bank loans outstanding, 65% of it was credit cards. All right. 12.3 billion was credit cards. 12.5 billion was credit cards. All right. That's a single week. That's a huge decline. Yeah. What did we also get last week? The senior loans officer survey. What did that tell us? We're going to continue to tighten standards on credit card loans, except for the super prime. It's not just prime anymore. Now they have the super prime category, but the most people getting the dynamic around the credit card debt is really tightening in terms of the availability. And then you're talking about not only that, the rejection rate on credit cards has skyrocketed. The rejection rate on expanding your limits has skyrocketed. I mean, seriously, like 44% of people are getting rejected when they ask now for an increase in their limits. That was below 20 just a year ago. And when you take all of that together, what you just said before really leads to the main point of this, where you reach a saturation point where consumers are either unwilling or unable to keep borrowing this much money. And you talk about inflation. Service sector X energy is 4.8. And out of 11 components, 8 of them are above 4.5% year over year. Yeah. I mean, so there's still a great deal of inflation to where the consumer with a 1% real wage gain with savings that, again, are below credit card debt is still choking. So to come back to that, what does that mean for gold? Well, yeah, the dollar higher is kind of the problem, and we saw that coming. So I don't know if you caught this, but we actually advised all our clients to completely get out of gold and silver, because we just thought this would be a thing where if Trump wins, the dollar goes higher and it's going to be a corrective mood. Now, what's interesting about it is open interest still remains very low historically. You had some pop. It's come down some, and especially even in silver too. So I think you have a situation here where you could, the market might look through to the next stage of the Fed move. And that's, it might be asking too much, but I think this correction, either it's over or it was the A wave of an ABC, and it'll rally and then come back down and make a new low, and then it's over. So that's what we're going to look at. We're going to look at that pattern and see if you break that pattern, and if you break kind of what would be the B wave counter reaction rally now, okay, that we're kind of, I think, just seeing beginning today, then that would speak volumes to this isn't ABC. The correction actually already bottomed. And I think when you talk about silver getting back down to $30, I mean, it's right where it broke out. I mean, it's almost perfect. Some of these things, the technical corrections are perfect, especially in some of the mining shares.
When you look at silver, I was going to ask about that, actually. I'm glad you brought it up. Because silver, of course, as most people listening to this are going to know, that it's both an industrial and a monetary metal. So you have both of those factors in play. What do you kind of see with the trajectory of silver? We've on the one hand, we're talking about the possibility of more Fed intervention, weaker dollar, ultimately driving precious metals higher. But on the other hand, we have the potential for an economic slowdown, which could put a drag on in industrial demand. How are you kind of looking at that and kind of playing silver right now?
Well, the thing I would point out right away when we talk about silver is something that was very evident this past week and this over the weekend, which is Xi in Peru celebrating the new port that they build there, so that South America can send all kinds of goods, food, in particular stuff to China, but also silver. And the Chinese demand for silver, actually the physical demand, is skyrocketing. And this is the way they now go, and this is what they're doing. This is what China's doing all over the world. I mean, this is a world war already, and it's about resources. And China beating the crap out of us. They're playing above the rim. And it pains me to say that. It really, it does. But in that context, I think that this kind of shows you too, when you talk about the precious metals in particular, silver still the poor man's gold. Silver still has a chance to kind of become its own tier one asset, whether that's official or not. Right. I mean, and you have kind of Peru, and it makes me think of the Spaniards and back to silver coins. And it used to be all silver. Right.
Yeah.
So it's kind of like, it's fun to think about, but at the same time, this is serious stuff going on here. And I think that when you look at silver, you really have a very interesting correction. The correction down to the low of 29.75 first gets below 30. That's psychologically important to me. Number one. Number two, it's a perfect 38% of the retracement of the move all the way from $20 back in October of last year. And you're at 50% retracement of the move from the August low at 29.60. So when you start talking about that and then put it in between 100 and 200-day moving averages, I mean, that's a technical setup where if this market were to get above 31.60 basis the spot futures contract, I think that's enough of a breakout to go with it and see. And if it comes up and it kind of fails and it turns out to be a B wave, you might end up getting out even. I mean, so it's not so bad. But if it isn't, and it is something bigger, and again, the other thing I would say too is if the stock market comes off, is that going to be bearish first and then really bullish, or is it just going to be straight up bullish? And I think it could be bullish. I could still see another scenario where, you see the tech sector kind of roll over and stocks come off and it just goes sideways for a while, waiting for something to happen, waiting for the Fed to happen. The economy, people think it's strong, so it's not really, going anywhere. And then, all of a sudden it's like, to the degree that you get a rotation out of all these and into the precious metals because they're rallying and because they are appreciating and because they're in demand, and it's global. This is still a central bank-led demand dynamic. It has not yet even been U.S. investors. It has not been a speculative boat. You've run this thing up to 2,800, 2,900 without a speculative fever at all.
Yeah.
So that's what gets me excited. And if you do the math on a long-term basis, now that we've had this kind of move and now correction, and we have some more numbers to deal with here, it gives us like a 1 to 3 year projection. It's a lot closer to 4,900. So, there's a lot of potential upside here. And think about just think about where we are now. And the dollar hasn't gone down at all. Imagine what happens when the dollar starts going down. This is where it really shows the devaluation, the purchasing power of the dollar is screaming from the gold market. And just imagine when the dollar goes down, how high this is going to go.
Yeah, absolutely. Are you a Bitcoin guy?
I am. I mean, let's put it this way. I look at it like, well, if all these currencies that are getting whacked, you look at the dollar, and we're so dollar centric. You have some currencies around that have just gotten smoked, and a lot of them are currencies from commodity producing countries like Angola, like Nigeria. You're talking about major energy sources. A lot of these types of places, even Ghana with the SETI had a big blow up recently, and a major cocoa producer. What happens? Cocoa quadruples in price to record highs, partially because of weather, partially because they can't get the product, partially because they're financially bankrupt. You have so many of these currencies where the purchasing power is getting annihilated that we don't understand because we're not seeing it and happening. It's happening all over. So what's someone going to do to protect themselves there if you say you're Angola or Nigeria? You're not running down to the pawn shop and buying bullion. You're not ordering somewhere and putting it in a vault in Idaho. What are you going to do? You have a phone. You can have a wallet. You can buy crypto. So to me, this is more of a global currency. The whole world, 300 trillion in debt around the world, over 307 trillion in debt. So think about that kind of thing with the currencies and how many people could theoretically buy something like that. to protect themselves from currency depreciation. That's why I like it. You kind of throw in Ethereum in because it runs kind of counter to it. It has the blockchain technology attached to it. It can do a lot of other things too. I feel that at some point down the road, the whole Decentraland will be something, not what people thought it would be when they're buying homes and clothes, and but it will be some kind of exchange of goods and services at some point in time. So I believe in all that kind of technology. What I don't believe in is some of these other things that people throw out there, like Doge, or like some of Solana or some of these things. And it just, to me, that's just riding the wave of a Beanie Baby type of mentality. And, I don't see the functionality or utility of some of these things. That's not to say that something like Tau with Bitensor, which is now an AI kind of protocol that maybe has some excitement. It's not to say all, so I'm open-minded about it. Let's put it that way. Sure. I think some of them have some value, and I think some of them don't.
So let me run this scenario by you. A cohort brought this up as a possible strategy, and I wanted to run it by you. You've had this extreme blow up in Bitcoin, massive move up, and we all know that Bitcoin tends to be pretty volatile. So, you could certainly anticipate a correction. This person was suggesting maybe it wouldn't be a bad idea to hold those crypto profits in a precious metal, say gold or silver, as you start to see it, correct back down, and then kind of preserve your wealth through gold and silver, and then reinvest it in crypto as it starts to go back up. What do you think of a strategy like that?
Well, we kind of do that without doing that, if you know what I mean. So, we're trading the futures market. So I watched the Bitcoin gold ratio. I was actually looking at the Ethereum breaking out against gold today, literally. So I watched that very closely. And it's not to, necessarily move money, but it is. It's like, where do I want to allocate my more aggressive leverage? Is it going to be here or there? Depending on what the dollar is doing, the interest rate. So I watch that very closely. I think it's important to, in that sense. I think too that the other thing that has to be mentioned too, kind of about Bitcoin and some of the crypto, and this is a kind of a far out thought, but it's something worth thinking about because I'm a guy that is paid to look at risk. All right. So what's the risk to some of these things? It's pretty simple to me. You want to talk about the weather and the science on the planet and all the things that are going on here that is really deep and really long-term stuff that human beings can't do anything about. And you start to talk about, like a CME, a coronal mass ejection, or something like a sunstorm, a solar flare. Bitcoin would be pretty useless if there's no electrical grid. So, you have to keep that in mind too. That's why, to me, I don't have a problem owning both. And I don't see this whole war between it's one or the other. I think that's kind of silly.
I agree completely. Yeah, that kind of drives me crazy. And I don't know about you, but I don't really view them as the same asset. I think there's a lot of people that really think that gold and Bitcoin are interchangeable, and I see them as kind of being different. They're certainly.
But people wanted Bitcoin to be digital gold. The problem is Bitcoin acted, and this is where you're in this transition. I think the important thing to look for in Bitcoin right now, and we call this market really well. Why? Because it trades it's an immature market. It trades technically like textbook. It's really been an easy market to make money. I shouldn't tempt the trading gods by saying something like that. But we got, it was an easy breakout above 66,000. We bought it. A measured count takes you to 99,140. We're there. Did I think it would happen this fast? No way. But, this was the move, and this was what we thought would happen. The question here is, Bitcoin, pretty much in its lifetime, for my observations, has acted more like a risk asset. It's acted more like the stock market. It's more correlated to the stock market than gold. So I think everyone wants it to be digital gold. And the question now becomes, can it evolve into that? And I think that it takes more broad use, like around the world. All the things I just talked about, I don't necessarily think are in place to happen. So, and this latest drive in Bitcoin, you have to ask yourself how much of it is because one big player is accumulating billions of dollars worth of Bitcoin. So there's a lot of questions. This is where it's always funny because, you have people that are in the gold market that are very similar to the crypto crowd, right? Always bullish. If you even say there's going to be a correction, they're all pissed off at you. And, it's like, no, these markets have ebb and flows. They trade. We time them. And, I want to deploy my capital where it's going to be making money. And if I think Bitcoin's going to correct, I'm getting out. All right, I'm not going to hold it. And then people are like, why'd you get out? Oh, my God. People go crazy because we got out. And it's like, doesn't mean I can't get back in.
Yeah, exactly.
I mean, it's really easy. So.
Yeah, people. It's interesting the way psychology works, especially in you get a lot of folks, and kind of in the political circles that I travel in. There's a lot of Bitcoin people and a lot of the hodlers, and it's almost more of a philosophical badge than it is like an investment. And so I think they have a hard time disconnecting from that psychological.
It is a badge. That's a good way to look at it. I like that. You're absolutely right. It's a badge.
And why we see that in the gold and silver markets as well. There's that same kind of mentality.
You do. No, it's the same thing. I mean, especially people that are, love the junior miners and that kind of thing too. Anyway, I think there's a lot of good value being created in some of these moves in the mining shares, though. That's for sure. And especially in the Canadian miners. Canadian dollar lower now. I mean, this is the other thing you want to talk macro. We could talk UK and Canada, both of which higher inflation this week than was expected, just like we thought it would be. Most of it coming from food. You're seeing the base effect in energy start to flatten out, okay? All you need is something to pop off in energy, and I think gasoline's bottom. Inventories of gasoline in this country are pretty low. I mean, and crude oil has has fallen rather, despite the fact that inventories are way down because you've used those inventories to pump gasoline out. So you would think gasoline inventories are built, but they haven't. Yeah. So this really sets up a situation where gasoline could be really bullish come the spring, come 3, 4, 5 months from now, right? So in that context, that's what we're thinking about in the calendar. And where were we last year in, February, March, April with gasoline? So this could be very interesting with inflation and how that affects central banks. So we might get lead time on that from the UK and from Canada. And the UK always tends to lead the US on the macro side. So to me, this week's numbers were really interesting, just to give you that little sideline. But I think the Canadian dollar metals shares like Torex is a really good candidate, or Wheaton. Those have been top performers. The corrections have been much more shallow and short-lived. They're almost all the way back towards their highs already. Obviously a lot of that has to do with Canadian dollars broken down against the US dollar, but so what? I mean, it'll still play it. And Fortuna Silver would be another one that looks really good too. It had a nice run and then it broke down. It's holding into some of these key moving averages and key technical retracement levels. So there's opportunities out there. We just did a big special on that, which we'd be happy to send any of your people in terms of which of these shares might have seen some technical bottoms here. And if not, then how much lower do they have to go to provide value, and how high do we think they can go in terms of looking forward?
Well, that's outstanding. I really appreciate again you taking the time. I'm gonna let you get off here, and it's about dinner time in my house. So, but before we go, I hope people can see the way that you do analysis. And I love the fact that it's macro and micro. You're looking at kind of both ends of the scale. So, if there are people listening and they're thinking, "Man, I would like to get more info and get in on Greg's analysis," where can they go?
They can email. Just email you straight up, Greg Weldon, GregWeldon @Weldon.online. And yeah, that's what we do. I mean, it's top down and then bottom up. And we really want everything to meld in together. You want the psychology, you want the position dynamic, you want the fundamental supply demand, you want the technicals, and we even do some quant work, some of the algorithms I wrote when I was in my 20s. So it's really blended. And we do the Global Macro Strategy Report, which is the research product. And that is pretty much global macro strategy. I mean, it's what we say, but it's also specific trades, and we give you specific trades, stop loss levels, the whole 9 yards. That's our main research product. We also do the Gold Guru, which is gold, silver specific, a lot of the mining shares, a lot of quant work, a lot of technical work on that too. Not so much the companies and their mining operations. It's really more macro influence and the bigger picture. But we also do uranium, which I think is really hot here, by the way. I mean, the top ranking shares right now in that sector are all uranium, Cameco and UEC and some of the other ones. Denison is up there. So Canadian also another flavor in the uranium stocks. And we do the crypto too. We do Bitcoin and Ethereum, and we actually got bullish, bought Ethereum today. We had been holding Bitcoin throughout the last few weeks, waiting for Ethereum to bottom and come back up through its breakdown pivot. And it did that today pretty convincingly. So any of that. And, I'm also a CTA. We have a high minimum. It's managed accounts. You open the account in your own name. There's no commingling of funds. You see the report every day on what we're doing. And we, it's basically the GMSR strategy is what we do in the managed accounts. It's all the same stuff. All the work that we do for the research is work I'd be doing anyway if I didn't produce research. for the trading business. So shoot me an email with any questions, or we'll send you some information or some of the research products.
Outstanding. Well, thank you again, and I hope you have a good evening, and we'll definitely have you back on as things progress.
Hey, I got to mention one more thing, because otherwise I would be remiss if I didn't mention. We're also doing the podcast. So it's money markets and new age investing, and it's kind of talks like this, but it's also more global and kind of economic, a little more political, a little more policy, and then a little more equity too. And looking at the ETFs and how can we use ETFs to kind of recreate a hedge fund / CTA portfolio, because those are the kind of things you have to be in the currencies, be in the bond markets, be in the commodities, especially food commodities. If you want to keep pace in the next round, being passively long stocks. That was okay during the 40-year downtrend in interest rates and inflation. It's not okay that now the 40-year downtrend has been violated, and we're on the backside of that. So that from that perspective too, it's at money_podcast on Twitter, or you can find us on any of the podcast sites, money markets and new age investing.
Awesome. I'll check that out for sure. That's good to hear. Well, again, thank you so much, and have a great evening.
You too, Mike. Thank you.
Well, another home run interview there from Mike Maharrey and one of our favorite guests, Greg Weldon. Truly fantastic stuff. And again, we want to thank Greg for sharing his incredibly valuable market insights. I trust you enjoyed that as I did. And that will do it for this week. Be sure to check back next week for our next weekly Market Wrap podcast. And don't miss our second weekly podcast, the Money Metals Midweek Memo, hosted by Mike Maharrey and available each Wednesday. To check out any of our audio programs, just visit moneymetals.com/podcast or find them on whatever podcast platform you prefer. Until next time, this has been Mike Leeson with Money Metals Exchange. Thanks for listening and have a wonderful weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes. For answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds, call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by to answer your call during business hours, Monday through Saturday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.